If I did, I would ding it. Ding, 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 ding. All right, we're going to thank you for your patience, everybody, as we're ready to get started. We're talking tonight, and some people already started the conversation. We're talking tonight about a way out of capital gains tax. So I'm Christina Hess. Welcome, everyone. And those of you on Zoom, welcome. It's nice to see you virtually. And those of you here in the room. And just my quick 30-second introduction. Some of your faces look familiar for some reason, but I am an estate planning attorney here in San Diego. I grew up in San Diego. This is home. I've been a lawyer for 22 years, went to Berkeley Law School, opened my own firm in 2009. And now I love being a lawyer. I didn't necessarily love it when I was in San Francisco at a big firm, but now I do. And my own father passed away suddenly, and I was his successor trustee, and he really wanted to leave a legacy to his grandchildren, and he just died suddenly before he got to finish what he started. So that's where I got my passion for planning. And I'll be honest with you, charitable planning is my absolute favorite thing. It's my passion. I love it. I love doing charitable trusts and helping people in this space. So without further ado, okay, so Linda was at a talk here a month ago, 6 weeks ago, 2 months ago. I did a talk here at Keller Williams for realtors about a way out of capital gains tax, because everyone right now, I mean, the markets may be starting to level a bit here, but most all of us, whether you've been a property owner for 2 years or 30 years, your assets have gone sky high, right? The capital gain tax is no joke. So we're talking about one strategy. I mean, there's a few strategies. There's different things that you can do, but the strategy we're going to talk about this evening is a charitable remainder trust. So this is one way out of capital gains tax. And so basically how this strategy works, and it's great for businesses, it's great for real estate, and it's also good for stock. So I had done 3 of them for a family that had highly appreciated stock, and they did one for each kid. And then sadly, dad passed away, mom passed away. And so now the kids are receiving the income from the trust. But how it works at a high level is you have a highly appreciated asset. In this example, and I have multiple examples that I brought tonight to share with you, but I'm going to just use a very simple example. So in this example, the client has a house in San Diego. This is actually a real case study, and she bought it near UCSD in the 70s. So they bought it for like $100,000, probably less, but I think that was what their cost basis was. And then it was worth $1 million. And then mom moved to Hawaii with daughter, and dad had passed away. And I think it was joint tenants, so they didn't necessarily and dad had passed away years before. So there was still a lot of appreciation, and they had, let's just call it $900,000 of gain. In this case, mom was not living in the property, so she didn't get the benefit of the $250,000 that you can exclude. So she didn't live there. So they were renting it to their granddaughter below market rent. And so they thought, okay, now's the time to sell. Let's sell the house. What can we do? And the tax bill was significant. So what kind of taxes are we talking about? The long-term capital gains tax rate is 20%. Then California, the wonderful state of California that we all live in, they treat capital gain as income. So if you're selling $1 million asset, you're going to be in the highest bracket. And so the capital gains tax rate is 13.3% in California. If you have property in Nevada or Texas or Florida or one of those states, there's no income tax. So that's a different, but California, you're tacking on another 13, and then the Medicare surtax, which is a federal tax from Obamacare, is another 3.8%. So you're looking at over 37% tax. So in her situation, it could have been $333,000 based on the capital gain of $900,000 in tax. So over a third of the profit would go to Uncle Sam. So then they thought, well, what can we do? So what she did is she transferred the property to a charitable trust. Mom and daughter were the trustee. The trust sells the property, 0 capital gain tax. So they completely eliminate the capital gains tax because the trust is now the owner and there's a charitable beneficiary on the remainder. So with the remainder trust, the initial beneficiary is you, or you and your spouse, or in this case, it was mom and daughter. So for the mom's still alive. So for the rest, I think she was in her early 80s when they set this trust up. Mom receives an income from the trust. I think in her case it was, and I'll come back to I think in her case it was, so it can be between 5 and 50%. That's what the IRS says. And so how you figure out what your percentage that you can take from the trust is based on whether you do a term of years. So you could do up to 20-year term, no more, or you can do your lifetime. So most people, if they're doing a remainder trust, will do their lifetime. So in this particular case, we did mom's lifetime, and then we did daughter's lifetime. And I believe the unit trust amount was 6.5%. So actuarially, what has to happen is when you set the trust up, based on the life expectancy of the recipients, you have to set it up so that the charity gets 10% at the end. So, once it's set up, so this went 6.5% to mom for the rest of her life. Mom's still getting her 6.5%. Then when mom dies, the 6.5% will go to the daughter. So like in that other case I told you about, mom and dad both passed, the kids are now getting for the rest of their life, they're getting that unit trust amount. So every year, the value of the trust is valued on the first day of the year. So if it's worth 900,000 in year one, then, or $1 million in year one, it's going to be $65,000 in annual income. Now, what happens to the money inside the trust? The property's been sold, you've got cash. Now, if you're the trustee, you can invest those funds, right? So some people will have a financial advisor who will set up an annuity or set up something for them to guarantee a certain rate of return. You can do whatever you want with the investments in the trust. I mean, obviously you have to be a prudent investor. You don't want to do anything crazy. If the trust makes 7% per year, then the trust is never going to run out of money, right? Because the unit trust is 6.5%. So the principal will grow. Let's say the trust only made 5%. I mean, who knows what's happening with our markets, right? Like it's possible, that people could not be getting 20%. Like we've all been you could be, everyone's a genius when the market's going like this, right? Like everybody's getting 20% or more on their investments, or at least 10%. But, things could change. So then what happens? The trust is valued every year. So either on December 31st or January 1st, whatever the value of the trust is, 6.5% of the annual value will be your unit trust. And then you get that every year for the rest of your life. So it's a really great strategy because it does three things, right? So the first thing is it eliminates the capital gains tax. So you went from paying potentially 37% tax to 0. So there's no capital gain. Now, when you take out your 6.5% every year, you will either pay capital gain or ordinary income tax on that amount. But for most people, some people, it's less common to do this with your primary residence because you need somewhere to live. And I'll talk about a way that we can do it for your primary residence. But most people, this is a really great strategy for investment properties because you're tired of being I've had properties over the years, like one of our tenants turned our house in the Bay Area into a pot farm, literally. $50,000 worth of damage. They had this hydroponic pot farm upstairs, this Rottweiler guarding it downstairs. I mean, it was disgusting, right? Because we were in New Jersey, long distance landlord, bad idea. So anyway, bad things can happen. You don't want to be a landlord anymore. You want to, capitalize on all your gain, get out of the rental business. This is a great strategy because why would you want to give that much money to the government? The other way it benefits you is you eliminate the capital gain, number one. Number two, you get an income tax charitable deduction. So when I give you the second example of a way that you don't have to put all of the property into the trust, you're getting an income tax charitable deduction. So it's based on the present value of the remainder interest. So I wasn't really a math person. That's why I went to law school, but the software will calculate these numbers for you. Like, and what's the present value of the remainder interest? If the trust is growing at 7% per year and you're only taking out 6.5% per year, the charity, they only have to get 10%, right? But they're going to get the full million if it's growing. Now, let's say the market takes a dump, it goes way down, the charity is not going to get 100,000 at the end. I mean, you don't have to guarantee it because nobody can control the markets. It's just at the time you set it up, you have to project it. You can't have it stretch out so long. One time I had a client, he wanted to do his life, kids' life, and grandkids' life. And it's like, that's too long. We can't go that far because you have to actuarially have a 10% remainder interest to the charity. So it really is a win-win. The other thing, so the charitable income tax deduction, it's really just depends on your tax bracket. And then you probably won't take it all in year one. So you can carry it forward 5 years. So let's say in this example, there's an example where it's a partial, the charitable deduction was $322,000, the tax deduction. So the charitable deduction is limited to 30% of your adjusted gross income. So if you make $100,000, you can take 30,000 in year one, and then you can carry it forward for 5 years. So you get to offset the gain, or your income from the unit trust amount will be offset with this income tax charitable deduction. So that's the other benefit. The third benefit is the money's going to grow tax-free in the trust because it all goes to charity. So it's a charitable trust, so it's tax exempt. It also gives you asset protection. If somebody tried to come after you, the principal in that trust is protected. So that's another benefit of this trust. And it has some, it has a great, and then the remainder will go to the charity, and you can change the charities. You can have more than one charity. You could have 5 charities, 10 charities. I had one client, they had 20 charities. The other thing you can do is you can change the charity over time. So let's say, one charity comes out of favor, or you have some new charity. Or I have a client where their daughter was in the nonprofit business, and she actually set up a family foundation. So you can have it go to your family foundation, which is really a win-win. Now, if you have it go to a private foundation, your charitable deduction limit will be 20% of your adjusted gross income on the deduction. So it's 30% if it's a public charity, it goes down to 20 if it's a private charity. But the point is you're getting to offset your income with this charitable deduction because you're making a contribution to charity at the end of you and your spouse or your lifetime. So, and that 5 to 50% unit trust is going to be based on your life expectancy. The older you are, and the older the lives of the beneficiaries are, the higher the percentage that you can take out. The younger, the floor is 5%. You can't take less than 5% per year, and you have to take 5% per year. So the IRS says you have to take at least 5% every year. So it can be a really great win-win strategy. So some people say, well, can I do this for my primary residence? I want to do this for my home, but I want to buy a replacement property. So I have a case study here on the slide, which I'll go over with you, but then I also have a couple of case studies, which I can go over with you at the end, where we actually ran numbers for real clients with real properties who are contemplating this. And I think in this case, the property was worth 2.8 million. So I'll give you some numbers. I can show you some samples with real numbers based on today's interest rates as well. So in this example, there's $1 million property, but the gentleman had a condo in Solana Beach, and he was like, I want to move to Palm Desert and buy a condo. So I don't want all of the property to go to the trust. What can we do? So we said, okay, well, you can exclude, this was a couple years ago. He could buy a condo in Palm Desert for 400,000 or so, right? Maybe now you can't, but this was a few years ago. You could do that at that point in time. So he excluded $400,000, and then he put 60% went to the trust and 40% came back to him as cash. So it doesn't have to be 100% of the property. You put the whole property in the trust, but then you can take some cash out. We can carve it out. So in this situation, we did a 60-40 split. 60% stayed in the trust. He got a 7% unit trust. I think he was 77 at the time we set this up. And so then the cash out was 400,000. He got to offset the 400,000 with his 250,000 gain exclusion because he lived there as his primary residence 2 out of the last 5 years. So that eliminated the capital gain significantly on the 400,000. And then he got a unit trust payment, and he had, like, Social Security was his only source of income. So for him, this was amazing because now he has $42,000 a year in income to supplement his other income. And then if he lives 13.7 years, which I think was his initial life expectancy, he would get $546,000 from the trust. So he's going to get an income stream. His family, if it went 39 years, if he left it then to his kids, they would get $1.6 million in payouts from this trust. So it just keeps on paying out. And then the remainder will go to the charity. And then he offset over $123,000 in capital gains tax. So it's really, it was a win-win. And the net cash to the donor was just $446,000. So that was enough at the time for him to buy a replacement condo and sell his Solana Beach property. So you can, it doesn't, if you wanted to do it for your primary residence, there is a way where you could split it. And so we had another case study here where we were talking about, okay, primary residence is worth 2.8 million. And replacement property, which had already been identified. So let me tell you a couple of the big no-nos, okay? So here's a couple of the big no-nos. No-no number one, you cannot have a prearranged sale. So what happens sometimes is people put their house on the market, and then the realtor, if you have an amazing realtor like Linda, they're like, oh, I just went to this seminar and oh my gosh, you can avoid capital gains. You really should consider this strategy. And it's like, oh, but you know, so-and-so gets an, like Linda wouldn't do this because she would have told the client before. That's why you're all here, because she's educating you. But people who don't know, and maybe they learn about it after the fact, we got an offer. You have to get out of the deal, right? You can't have a prearranged sale. So ideally, when you analyze this is before you decide to sell, because what needs to happen is you transfer the property into the trust, then you as trustee, and you can, this is an irrevocable trust. Okay. So once you do it, you can't change it. Okay. So you can transfer it into the trust, and then the trustee sells the property. Now, if it's in a market like ours and it's a residence or something like that, that's going to sell quickly, no problem. If it's a commercial properties, the more expensive the property, the smaller the market. So if it's a commercial property, we want to do a special charitable trust and we want to do a flip CRUT. It's going to flip. So you get the net in, instead of getting a unit trust, you're going to get the net income from the trust. So I'll give you an example. I had a client, big property in LA, their capital gain, each brother owned 50%. They inherited it. Commercial property in LA was, they had a buyer for like maybe $7.5 million. Each of them were going to have over $1 million in capital gain. So brother one decided not to do the CRT. He did something else. I don't remember what it was. Brother two was my client. We did a CRT. His daughter had a charitable foundation they wanted to set up. So this was a great strategy for him. But the property it fell out of escrow. It didn't sell right away. But fortunately, when we set it up, I set it up as a flip CRUT, meaning a flip charitable remainder trust, meaning there's a triggering event, which is the sale of the property. So you don't have to pay the unit trust. There's no way the income from the rental is not, When you do a CRT, your income goes way up usually. So if you're getting like $3,000 a month rent and suddenly you're getting, 5 or 6% of $1 million, like you just get a huge increase in rent. But if you haven't sold the property, your $36,000 is not going to be able to pay that $60,000 unit trust. So you just get net income, and then the triggering event is going to trigger the charitable remainder unit trust to pay out. So that's how you want to do it if it's a difficult to sell property. So if you had a client with, as the market maybe starts leveling off, the average home will still sell very quickly. But if you have a higher end home, it might be a longer period. We might want to consider putting this trigger in to protect you. So that's another great strategy. So you can do that for commercial properties, more difficult to sell properties. You can also use this with stock or businesses. So you've got a sale that's pending in a business, you've got stock that you want to sell because, it's here and you don't think it's sustainable, but you don't want to pay all that capital gain, So probably you would need to, for this to be worthwhile, it's probably you need like $250,000, like you probably wouldn't want to do it. There's too much transaction cost to do it for a smaller asset class or value. You want to have a minimum value to make this worthwhile for you, but you definitely can use it for different types of highly appreciated assets. So let me just show you, there's kind of two examples that we have here. Any questions so far about what I've talked about? Yes, sir.
How secure is that investment you're doing? Some people want $1. How secure is our investment?
So the question was, for those of you on Zoom, is if you do this and you sell this $1 million asset, how secure is the investment once it's in the trust? So you're the trustee of the trust. So it depends on you and what you invested in, right? So you could have, you could invest it in stocks and bonds. You could put it in, you could do an annuity so that you guarantee a payout, so that you're going to be able to hit that unit trust amount every year. So it's up to you and what you invested in, how secure it is.
Yeah, but what's that 6.5%?
It's going to be on the value of the trust each year. So if the trust loses money in year 2 because the market took a dump, then you're just going to have a smaller payout, because it's going to be 6.5% of the value on January 1 of that year.
So it's not a return on investment. It's you said what percentage you want to true every year.
It's
So you
fixed.
could say 5%, 10%, 15%. But in terms of principle that you put in a charitable trust, you have the control of your money, however you want to invest it.
Mhm.
But you have to take 5% out.
You do. You have to take the 5% each year, the unit trust. Pay yourself. Yes, you have to, but you can.
How the trust is doing.
It doesn't matter how the trust is doing, because the one who hurts at the end is the charity, as long as, and if you're a reasonable investor, then hopefully you're going to at least get 5% per year, or invest in a annuity that's going to guarantee that. That's why some people will go that route. Yeah. Yes, sir. Another question.
I have two questions. The first one, the charitable deduction is limited to $600. So how could you deduct charitable deduction on your income tax when the Internal Revenue allow you only to deduct $600?
No. It's 30% of your adjusted gross income.
That's not what the CPA did on our taxes. They say that taxes charitable deduction are limited to $600 for federal and unlimited for state. So you are limited in the charitable deduction. That's the new law that they apply to what you could exempt from your taxes. My second question to you, once you have the money in a charitable trust, can it be reversible back to you if you don't like it? Or once you put it there, it's locked?
That is one of the downsides. You have to be sure about, the question is, the question is the limit on the charitable deduction. I'm not aware of what you're speaking about because we literally just did one of these and
Well, you
that's,
put the Google charitable
Yeah.
deduction for income tax, and you will see the amount that you are limited to deduct. And then they have, and prior to this year, you are not able to deduct any charitable contribution, but because of issue affect some of these charitable places, they increase it to $600.
yeah, no, it was 100% on cash donations. And then property donations is 30% of your adjusted gross income. So if you have income, maybe if you don't have any income, then you can't.
No, that's not, well, anyway,
Okay.
thank you.
And then as far as the second question, the irrevocability of this trust, it is. So you need to be sure. You can't undo it once you're in it. It is irrevocable. So you can accelerate it if you don't want the income. You can accelerate the payment to the charity. You can sell your interest to a third party that'll buy out your lifetime income stream. There's things like that you can do, but otherwise there is a market where there are people who buy charitable remainder income interests. There's a company, Sterling, that does that. But other than that, once you do this, you're locked in. Yeah.
Approximately $1 million rental profit. How much costs involved for that?
As far as the transaction costs,
And also for the trust and all that.
yeah. So the question is, and I do flat fees. So the flat fee for a charitable remainder trust and the workup and everything, and the deed transfers and all that, we do a flat fee of $5,000. So it's not based on, I know some attorneys that do deferred sales trust, or they do these different types of capital gains bypass trust, they charge 1% of the savings. I don't do that. It's just a flat fee. It's $5,000. It's,
It doesn't matter how many property you have, or 5,000 per property.
well, no, it's per trust. So you could put multiple properties. The question is, does it matter how many properties you do? You could put multiple properties in one trust. The problem is this: if you put one in now, the calculation, the actuarial calculation and the unit trust amount is based on today and what the 75/20 rate, what the interest rate is. And then if next year you're like, oh, let's put another property in there. I actually had a client do this. He was like, we start with one and we'll see how it goes. And then they added another property in year 2, but then the calculation, the charitable deduction is going to be a little different. The, as long as you're within the life expectancy, your unit trust didn't go up, so that's fine. You just have to rerun the calc. You can definitely do it. And I've had people do that. You do one property, then you add another, or maybe you do 5 in one, or you can, if they're different types of properties, you could do multiple trusts, but you don't have to. With a remainder trust, you can add property. With a charitable lead trust, you cannot. So there's different types with the lead trust, you can add property. So
If you want to do it at the same time.
yeah, then you can put 2 in, you could put 3 in, you could put 4 in, there's no cap. That's actually simpler. Like I had a client, he had 3 lots and he put all 3 in. And then he wanted to put another property, and you can, you
The
just,
best way is to do it all at once.
yes, because then the numbers, the actuarial analysis and the numbers, it's, yeah. The 75/20 rate, your life expectancy, everything to calculate to make sure that you're guaranteeing that de minimis 10% remainder value. Yeah.
Okay.
Yeah, you're welcome. All right. So any other questions? I don't know. We'll do the Zoom questions at the end if you Zoomers have any questions, just because I think how this is set up with the slideshow, it's hard for us to get to the questions. So let me just give you one more example. So in this example, there was a $2.8 million property, and the replacement property was going to be 1.6 million. So the question was, do we want 0 tax or a little bit of tax? So the analysis was run 2 ways. And so if you guys were interested in this strategy, you can send me the data points, your ages, the fair market value of the property, your cost basis, your tax bracket, and we can run an analysis and you can look at your numbers and be like, does this make sense for us? Is this a good idea? You know, and then you just want to make sure, remind me to mention the other no. The first one is no prearranged sale. Remind me to mention the other one, because that can be a roadblock as well. So if this seller put his $2.8 million property into the trust and he kept out 1.6 million cash, he's going to have a little bit of tax. So he put 1.2 into the trust and got a 6% unit trust based on, I believe husband and wife were 60 years of age. So they could get a 6% unit trust. Their income would be $72,000 per year over life expectancy of 35.4 years. So they would get over $3 million over the course of their lifetime. The taxable gain was $828,000. The tax deduction was $263,000. So the higher the unit trust, the more money you get, the lower your charitable deduction, right? So you can play with the numbers to get where you want to be. You can't go below 5%, but if you want a bigger charitable deduction because you have a lot of income, you can take a lower unit trust. You could be at like 5 or so, you know, this particular case study, they're only 60. So they have over 35 years of life expectancy, which is driving the trust to live a long time. So as a result, their charitable deduction went down. The older you are, the bigger the charitable deduction. So you kind of see how that works. You can kind of play with the numbers to get where you want to be. So this one would have a little bit of tax. The other one was a zero tax plan. So with this one, he got 1.29 cash and put 1.5 million into the trust. So bumped up the trust by $300,000. And then he was able to eliminate his capital gain completely because on the 1.2, he got the him and his wife got would get the $500,000 section 121 deduction because it's their primary residence. But then he's not going to have enough cash to buy 1.6 million. So he would probably have to get a small loan to make up the difference. So he would have over $1 million towards the new property. And then his unit trust payment is going to be $90,000 a year based on a $1.5 million trust. So huge income increase. And they were both, you know, retiring. So they wanted to downsize. They didn't need the big house anymore. The replacement property is smaller, you know, so this is a great strategy if you're in that situation as well. And you can run it both ways. You could say, run it with a zero tax outcome, run it with giving me the max cash to buy the replacement property. And then you'll have to use some of your charitable deduction to offset the capital gain tax. So you can, you know, that the good thing about doing a partial sale where you get some cash is the part that's in the trust, you take that income tax charitable deduction and it offsets your gain. Other people have taken the charitable deduction and used it towards Roth conversions. So that's another creative way that you can maximize this. So this is just a case study, the one that I talked about, where they kept 400,000 out. The other thing that is worth mentioning is, let's say you do this trust and your rental property or this property was an asset that potentially was going to go to your kids. And you want to replace the asset for your kids because they're not going to get it. You can take that extra income and get a life insurance policy. So you could get a second to die life insurance policy because suddenly your income went from whatever it was and now you have 90,000 coming from this trust. You could afford a $15,000 or $20,000 second to die life insurance policy, a permanent policy that would go to your kids in a life insurance trust. So some people will pair the charitable remainder trust with an irrevocable life insurance trust, because who knows what the federal estate tax exemption is right now. How much can you pass tax-free when you die?
11.8 million.
Yes, adjusted. Yeah, adjusted for inflation in 2022, it's 12,060,000. So 12.06 million you can pass when you die. And then it potentially expires when?
December 31st, 2025.
Yay, Linda got it. December 31st, 2025. And what's it going down to, Linda? 6 million.
But it could be administration might go down to 2.
Yeah, so we don't know what's gonna happen.
So also, the beauty of what we presented, is that could be changed by the tax law, if they want to change the tax law in the future, could that be affecting a lot of these trust?
Oh, okay, so good question. What happens if they change the tax law? Could that affect a charitable trust? Is that your question?
Yes.
Okay, great question. So the good news is, once you do something and you have it set up and established, it would be unconstitutional for them to take that away from you. So you're grandfathered in, and charitable trusts have been around for hundreds of years. So this is not a new strategy. This is something that wealthy families have been doing for generations. It was codified in the 1969 tax code, but it pre-existed that. So this is not like some fly by night, like, oh, this is some, new thing. No, this is well settled, well established. It's been around for hundreds of years. It's been in the tax code for 60 years. So this is not, so this is very solid. You're on solid ground. And from a public policy standpoint, the government encourages charitable giving because it takes the burden off the government, right? The more we provide for the poor or the needy, or, the more charity we do, the less the government has to fill in those gaps. So it's, as a matter of public policy, we encourage, that's why I say there's two types of charity, right? There's two types of charity. There's voluntary charity, where you pick your charities. Like, what are you passionate about? Who do you want to help? Like, what are some of the things that just make you mad? Is it animal welfare? Is it, poverty? Is it, what is it? What are those things? And then what's a good charity that's a good steward that is helping that thing that makes you mad? That's your voluntary charity. And then there is involuntary charity. And guess what that is?
IRS.
Yes, IRS, Uncle Sam. That exactly right. Ding, 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 ding. Linda's hosting this, so she can't get a prize, but
I want to learn, because this is the third round I listened, and because I'm sitting with my other client when they're setting this up.
Yeah.
And then after you present last time, the following day I was with another client and then another presentation.
Yeah.
So this is my third time. But
Awesome.
my clients are doing this.
So you're piecing it together.
Yeah.
It's all coming together.
I'm learning more, because it's really complicated.
It's
because
very
so many
different
different things,
Yes.
And then actually after your presentation last time, I talked to my Jewish mom, I called my Jewish mom 2 days later about this. And then she told me she has a property in there that she could use, but it's already in escrow.
Oh,
So why the offer of that?
unwind the
And
escrow.
The attorney said, you better don't just unwind, it just, it will be really, there will be already a paper trail.
Prearranged
So she did
sale.
not have to pay a whole lot of taxes, but now she's getting this set up over other property, because she has several properties in San Diego.
Wonderful. So Linda's been learning, clients are setting up these charitable trusts, and this is her third time through. So that's why she's getting all the answers right. She has an unfair advantage.
She has a question.
Okay, I'll be right with you in 1 second. I just want to finish this thought, and then the life insurance. So you could get it, if you're married, you could get a second to die policy, so that when those are less expensive. So when the second person dies, it's going to pay out to an irrevocable trust. So the reason I brought up what's the federal estate tax is because you might not think you have a taxable estate right now, because everybody has $12 million they can pass tax-free when they die. And if you're married, that's 24 million. We have a lot of people in Southern California who are above that, but most of us are not in, that's why Bernie Sanders called it the 99% Act, because it's like 1% that is over $24 million or 23 million. But when it goes down to 5 million, adjusted for inflation, then suddenly it's not inconceivable that a lot of people could have a taxable estate. So if you put a life insurance policy, this is another one of those tried and true sort of old, well-established things. You put a life insurance policy into an irrevocable life insurance trust, you just remove the death benefit from your taxable estate. So when you die, you're taxed on everything that's in your name, everything you own, your house, your IRA, your retirement. If you have life insurance that's not in an irrevocable trust, if you had $1 million policy, that's part of your taxable estate when you die. If you put it into an irrevocable trust, so what people do with these charitable trusts is they'll get a policy, say that property was $1 million. So they'll get a second to die $1 million life insurance policy, put it into a charitable trust if they think they'll have a taxable estate. If they don't think they'll have a taxable estate, just put it to flow into your revocable trust. And then you have this death benefit for the kids to replace the asset you're giving to charity. So that's kind of a great strategy as well. So last point, and then I think we're almost done, and I'll take questions. The last thing, the other big no-no. So Linda, you can't have a prearranged sale. So her client was already in escrow. It's kind of, her attorney told
She's a
her.
realtor herself, so.
Yeah. Oh, so not a client, but another realtor was in escrow. The attorney said, no, paper trail. You'd have to start over, basically break the contract, get out of escrow, put it on the open market again. And then, but that buyer might not be so thrilled about doing that, because what if somebody else came in higher or something? Maybe now that wouldn't be a problem, but so you can't have a prearranged sale. The other big problem that stops people from doing this is you can't have a mortgage on the property. So those are the two big things that stop people, is if you have a mortgage. So remember the story about the UCSD property? She had a really small mortgage, but it didn't stop us because we just got a loan to pay it off before we put the property into the trust. So the realtor was able to facilitate a loan for her to pay off the mortgage. You can call it a bridge loan or a hard money loan or whatever. You just get a short-term loan, pay off the mortgage. When escrow closes, they get paid back. That's okay. But you can't put a mortgage property into the trust. It messes up the tax exemptions and everything else. So those are kind of the two big no-nos. Other than that, just making sure you have the 10% remainder and kind of just making sure that the numbers work. And then this is a great strategy. It really can be a win-win-win, because I personally would rather voluntary charity than involuntary charity. We already pay our fair share, especially in California. We're taxed pretty heavily on gas, among other things. My cousin lives in Ohio, and he's like, $4.50. I'm like, okay, we're almost at 7. So thank you, California gas tax. Anyway, I'm sure there's other factors too. But so that's the main thing that I wanted to discuss as far as formal presentation. And then now I'm happy to take any additional questions. And then the Zoomers, if you guys want to bring questions, then do you want to?
I'm reading the top.
Oh, you are.
I have a question about it.
Oh, okay. Linda's reading the chat, Zoomers. So if you guys, you're not Zoomers. That sounds like boomers, but if you guys have any questions, put them in the chat. Linda will get them to me and I will answer them. Yes.
I think I missed